This is Andrew Stotts of A Stotts Investment Research, and now I want to walk you through part 2 of the Introduction to the Valuation Masterclass. And in this section, I'm going to go through a little bit more detail about how to use this model. So to recall, we have the following sheets: FS, forecast, discounted valuation, multiple valuation, the output file, the main assumptions file, and then this is some pictures that you're going to learn about how we paste these pictures. Now let's go back to the forecast or the financial statement file. Remember, I told you there's really nothing you have to do in this file. This is where we feed in the data from our database on a particular company. Now, the information at the top, I'm just going to review here by expanding. And what you're going to see is the information at the top should automatically be there, and it should be correct. And it's related to the company, the country, those types of things, the currency. These things could be changed, but generally no need to change them. Also, you can see that we do a calculation of beta here for 3 years, 5 years, 10 years. And that gives us some idea about that company. But again, you don't have to fill that in because it will automatically be in there. Now you'll also see a gray area here, whether that's for the annual, or what you'll always notice in the structure of my file is that the annual will be here and the quarterly will be next to it if there is any quarterly. Now why are there gray areas here if I tell you that you don't want to put anything in here? Well, the reason for that is that sometimes a company will announce its profits for a quarter, let's say, and what you'll see is that the information won't be into the model instantly, and you want to make an assessment of it. So you can actually key in the numbers right here if you wanted to. So let's just say in December the number was 1411, and let's just say that it became 1500. Everything would change based upon that, and it would carry that forward in this case because it was just a simple model that we're doing here. All we're trying to do is quickly respond if a quarterly result comes out for the latest quarter. We would key it in to match the latest quarter, and that would give us some basic information that we can go off of, whether that's in the balance sheet. Now, also, the next thing that I want to show you is that in this file, what you're going to see is I always have the same structure, which is the P&L, and then after the P&L I have the balance sheet right here, and then after the balance sheet I have a cash flow statement right there, and then I finish up with ratios, and then you can see some of the raw data that we're pulling in this case from Thomson Reuters here. So now once you get the structure of it, the structure doesn't change. So what is the structure again? Let's just review that. Remember that the columns here are annual and the columns here are quarterly. You'll see that structure in every model that we do. And then you'll always see some sort of dividing line, such as we have right here, and that will be a P&L, which we always start with a P&L, and then we move to the balance sheet, and then on down. So again, there's not much you have to do in this file, but I just want to explain the structure of it. But what we can see is that the raw data, this is the most recent data right here, and this is the most recent quarterly data. This data then gets automatically pulled into the forecast file. So now I'm going to zoom in a little bit on the forecast file, and let's just look at the P&L as a start. So first thing we can see, in fact, I'm going to make it a little bit bigger, and then it'll be really easy to see. First thing you're going to see is that up in the left-hand corner, you'll see that we've pulled in the name of the company, the ticker code, consumer discretionary, and then you'll have to make a decision about the first valuation period and then the last interim period. Now, what that has to do with is something that we can talk about in just a bit. But basically, you don't have to fill this in for right now. Now, what you can see is the structure is the same. There's annual, and then there is, next to that, there is quarterly. And what you can next see is that in order to understand how we're going to forecast this, we want to look at the past, and then we're going to forecast the future. All right? Now, the next thing that we need to talk about is many people, when they work on a spreadsheet, they use something called freeze panes. And when they freeze panes, it allows them to move, for instance, to the right and keep the columns here to the left. Now, I recommend that you don't use freeze panes. I don't like it. An alternative that's better in my case, in my opinion, is split. And split, you can just put the cell right there, and it will make a split just like freeze panes does, except you have much more flexibility. You could break this into 4 quadrants like that. Or you could make this really small up here, and then you could see a lot down below, right? Now, some people like, and then, of course, you can double-click on it, and it's gone. Some people say, well, I just want to split the screen in half where I see this half, but I don't need to split it here, right? And some other times, so now I'm going to remove the split. Sometimes we say, let's split the screen here in half so I can see the upper part and I can see the lower part section. So I'm going to remove the split, and now I am going to put the split about here. So now, once I've got that, from that, I can use that to then say, okay, my forecast on annual, well, this company doesn't have any information for 2009 and 2008 and beyond, so I'm not too concerned about that. And so I'm just going to push it right to 2010, the first year that this company, which is called MC Group, has data. So here we can see the information of the company. And the next thing that I'm going to show you is, and so let's just go look at this P&L right here. Now what I want to do is show you about the forecasting. If we keep going down by about line 152, we're going to see forecast variables for profit and loss. Below that, we'll see forecast variables for assets. But let's just look at profit and loss for a moment. And here we have, this is the company's current revenue. So now if I want to look at the revenue growth that has been happening in the past, it's 14%. Now let's just say that I think that this company is going to expand a lot. And therefore, I'm going to say it's going to be 25% each year. Wow. So that means the growth is going to really accelerate here, and we can see that. So this is the forecast area. Now, the thing that you're going to next see is these green lines. The green lines are your check. What you want to do is look at the EBIT margin, and EBIT margin is your forecast up till EBIT. And EBIT margin is the forecast, the earnings before interest and taxes, divided by total revenue. And what we can see is that the company's latest margin has been about 20, 21, something like that. And now I'm forecasting 21, 22, 23, 24. You have to ask yourself, am I confident with that this company is going to be expanding its margin? Or do I think that this company would be contracting its margin? Well, main thing for that would be in this area, which is the gross profit margin. Let's just say I think the company is going to be contracting its margin, and therefore I think it's going to come down to 52. Let's do that. 52. Now, what we can see is that, whoa, this green EBIT margin goes from 20 to 18. Now, I haven't looked at the years after that, but let's just do it this way. I'm going to highlight that and press Control R. Hold on. Control R just fills the cells to the right with 52. And what we can see is that the company's margin will go down, but then it will start to come up a little bit, and that has to do with SG&A. You can see SG&A expenses, the sales, general, and administrating expenses, are actually falling, and that's causing this margin to fall. So the point is that the green line is your check. By the time you've finished your forecast, you want to look at this net margin, and you want to look at net profit growth. If you're comfortable with those two items, then you're ready to move on to the asset side of the balance sheet. And that is going to bring you to cash. And you're going to be looking at this row, line 47, and you're going to fill in some cash amount. Now, before I go on, I want to talk to you about something that you may find a bit difficult in this model. In this model, when you click on the cell, you are not going to see any formula. Why? Because I've protected those formulas. Why have I protected those formulas? Because those formulas are irrelevant. The purpose of this class is not to teach you how to build a financial model. It's to teach you how to value a company. I've already built the best financial model that can possibly be built. I hope. Maybe you can help me improve it. My objective is not to have you understand every single item in the forecasting and how the calculation works. My objective is to get you to understand how to actually do the forecasting. Now, of course, in the wiki that we've done, we explain every single formula. So if you say, I don't understand how this accounts receivable one works, you can go into the wiki and you can get the formula, and it shows how we calculate this. Now, of course, the formulas are pretty simple, basic, straightforward. However, in our program, in our Excel file here, we have a lot of, complexity in the formulas. And so that's something that we just have to work through. And the complexities in there are because we're looking at 40,000 companies across the world. And so we can see so many unique situations that we need to consider. So that's why it can be quite complex to see the formula. So don't try to look for the formula, but if you really want to try to get the formula, it's in the wiki and you can go through that. Now let's go to the next sheet. Once you've done your forecast right, now we're just going to go into, I wanted to make that bigger. We're going to go into the valuation sheet. And in the valuation sheet, what you're going to see is that all you have to do in this section, I'm going to zoom it in. Let's see. All you have to do in this section is that, first of all, it's going to pull in automatically the country that we're in, which this company is listed in Thailand. Then it's going to show us the risk-free rate for this company. Now we can see, for this country. We can see that Thailand, over the last 3 years, the risk-free rate was 2.8. Over the last 5 years, it was 3.1. And over the last 10 years, it was 3.6. So what risk-free rate should we use? Well, let's use 4. We can talk more about that later. And then we can look at the market premium, equity risk premium. In other words, how much was the market's return over the risk-free rate for each of these periods? So we know the market return, for instance, was 10 here. Risk-free was 3. Therefore, market equity risk premium was 7. And so from that, we can get our expectation of the market return. Then you fill in the company's beta. Again, we provide the beta right here from the past. You fill that in right there. And then after that, it's cost of debt, average tax rate, the debt as a percent of total capital, and then you've got to think about a fade period. Now, fade period is saying that we need to think about that company's profitability, in this case, return on invested capital, that eventually it's going to fall. No company can maintain a super high level of profitability forever. And so we fade it down, and we give you some choices. You can put in 3, 5, 10. And when you change that, let's just change it to 3. Watch the graph on the right. When we change it to 3, the graph shortens, and it automatically just shows 1, 2, 3, done. Now let's just say that we increase it back to 10. Watch that graph. The graph expands again, and the fade is over a longer and a steadier period of time. And then from that, we can also look at growth in invested capital and then return on invested capital. Now, this company's return on invested capital is super high. And our weighted average cost of capital, let's say, is low. It's about 11.6. Well, eventually, the company is going to fade down to the 11.6. You can see it as 12 here. It's going to fade down to WACC. Now, we do have some rare cases where a company may be able to fade down to some premium to WACC, let's say. And in that case, instead of fading down to a WACC of 11.6, it fades down to a WACC of, or a number of 13.9, which is a premium, a 20% premium to WACC. Most of the time, you don't want to do that. You want to just use the none. Then we look at the terminal growth rate, and what you're going to see is that you cannot enter something more than 5%. And that's because a company growing at 5% could potentially be growing faster than the overall economy from now till forward periods. That would be unrealistic. Then we can look at the current dividend payout ratio and any changes we may make to say in the final fade period, it would be some amount. And then from that, you're going to get an output. And that output is the free cash flow statement that comes. So free cash flow to the firm, we can see right here. And here's free cash flow to equity, which we can see right here. We can also see the amount of invested capital in the company and the growth in that. And then we do a present value discounting right here. And when we do that, we come up with a value, a total value for the company. And we can say we have 3 periods: discrete, fade, and terminal. And what we can see here is the actual present value of all of these periods. And that present value is based upon our cost of equity, which we calculated here, and our weighted average cost of capital, which is there. And from that, we can then go through and say, oh, do we need to add anything such as cash and long-term investments? Because remember, free cash flow valuation is valuating the company's core business. And then we can come up with the equity value right here of the company. And then we come up with the number of shares, that equity value divided by the number of shares. And we get some valuations related from free cash flow to the firm, free cash flow to equity right here. And we can understand where that relates to the current price of the company. So that gives you some basic overview. When we then go, we can see the next thing below is the dividend discount model. And then if we use a residual income model, we can see that here. And we can add in other models if we want over time. But really the truth is that dividend discount and free cash flow are pretty much the main models we want to look at. And truthfully, most people use valuation when they value a company. And so this is the valuation area. In the valuation area, I'm going to expand it a little bit so you can see it more clearly. In the valuation area, again, we pull in the country and we sector, and then we say, okay, that regional relative valuation compared to the consumer discretionary. So what that means is that what we're looking at in this case is Thailand, but we could look at the world, or we could change that to Asia ex Japan. We could look at it in different ways, but let's go back to Thailand and let's take a look at this company. The PE of this company right here is, let's say for 2017, it's 19 times. And the PE for this sector, consumer discretionary in Thailand, is 21.6. And then this sector across the world is 14.9. And then across Asia ex Japan is 12.4. We can look at the same thing for price to book and see that this company's price to book is 4.02. For Thailand, the price to book for that sector, right? The company's price to book versus the consumer discretionary sector in Thailand, in the world, and in Asia ex Japan, we can see that 4 times price to book is higher than Thailand and higher than the world and higher than Asia ex Japan. We can then look at the ROE of this company relative to similar companies in Thailand, in the world, and Asia ex Japan, and see that it's pretty high. And from that, we can get a basic understanding. We can also look at the dividend yield for Thailand, for this company, for Thailand, for world, and Asia ex Japan. Now, that gives you an overview of that section. Now, let's just look at the output section. Again, this is a section I use a lot because I just like to capture the big picture. I don't care about everything else. What I just want to see is what are the main assumptions and what do they show. So, therefore, I would usually expand this to be, let's say, to that. Okay, so now from this, I can see the annual and I can see the quarterly. And to me, the only thing that I can see related to your forecast is this line right here that designates that this area right here is the estimate, which you can see 17E, which automatically comes in here, and 16A means 2016 actual. So this is where we can kind of see, does it make sense? Let's see. Let's look at the net profit. Okay, yeah. Wow, that's increasing quite a bit, right? Maybe that's too high. It's gone up by 3 times by the time you get here. I'm going to look at the balance sheet and try to understand what the balance sheet looks like, the cash flow statement, the number of shares outstanding, and understanding what you've done. But also, I'll be looking at, let's say, what was your gross margin assumption? Why did it go from 56 down to 52? What's your reasoning for that? And then I can look at your return on equity. Well, this company's return on equity was, let's say, 19, 20, something like that. And now I'm saying it's going to be 46. Is that realistic? Are you sure? That's pretty high. So those are the types of things that I would look at, try to understand. And then I can do a return on invested capital analysis where I look at the NOPAT, net operating profit after tax. I make other adjustments. I look at the invested capital. And then from that, I can try to calculate, what I think for instance, the non-operating assets as a percent of total assets are. And I can get a picture of what's happening with invested capital. And then I can look at free cash flow to the firm and free cash flow to equity. This page tells me all. So I love this page for checking my work, and you should be using this page before you eventually submit your final of any company that you're working on. And then last thing I'm just going to show you is this page, and this is the main assumptions page. And this is really an output that's related to valuation. And the first valuation that we would look at is the free cash flow valuation, or cash flow valuation, which is a DDM, free cash flow to the firm and free cash flow to equity. Remember that discounted cash flow valuation, the term discounted cash flow is a general term. It means we're discounting. And what are we discounting? We're discounting cash flows. It doesn't matter whether those are dividends or free cash flow to the firm or free cash flow to equity. So anytime we talk about a discounted cash flow, we're talking about a generic concept. Now, when we discount the free cash flow to the firm, now that's a slightly different thing. We call that a free cash flow to the firm valuation. So you can see I call this discount valuation because these are three different cash flows that we're discounting. And we can see our DDM value, dividend discount value, is 48. The free cash flow to the firm is 19.7, and the free cash flow to equity is 35. Why are these so different? Well, this page would allow us to start thinking about that. What were our discount assumptions here? What were our weighted average cost of capital assumptions? What was our dividend assumptions? We can see the output of the dividend discount model, and then we can also see the output of the free cash flow to the firm and free cash flow to equity model, and ask, is there something different here? Wow, look at the difference in the cash flow right here. Free cash flow to the firm is 1380. Free cash flow to equity is 2444. Now, these aren't meant to be the same, but when they're dramatically different, we may come up with a different result. So if we look at free cash flow to equity, we can see 35 baht in this case is what this company is being valued on. And we can see free cash flow to equity. Yes, there is a lot of cash flow here compared to this one. So that's a question that we would ask as we go through the valuation. Then if we look at our multiples, we can look at a PEG ratio, which is PE to growth, and price to book relative to ROE. And we can get a bigger picture by chart and here to understand. And then finally, we have a sensitivity analysis where we try to say, in this case, the company's sales are 10.2. That's what you're forecasting. And what would happen if sales went up to 20.2 or 30.2? In other words, we added 20 percentage points. How would that impact the earnings growth, the ROE, the net margin of the company? And how would that impact? So this is the company's fundamentals over the next 5 years, and this is the company's valuation over time. So the first two relate to changing sales growth and changing gross margin. The next two relate to what if the discount rate changed and what if the terminal growth rate changed. So these are the main sheets within this file. Remember, this Life Force sheet is more of an output sheet that we'll tell you about more later. So that summarizes part 2 of how the model works. I hope that helps you get a handle on the model, and very quickly, it'll be confusing in the beginning, but very quickly you'll learn how to use this model to make amazing valuations. I'll see you in the next video.